Let's get some insights on the news that's shaping broad market action. For that, I want to welcome in Dale Smothers, President and CEO, RDS Wealth Management. Dale, it's good to see you. I was happy to see that you were in the lineup today. All right, let's talk about the current market environment. You say it is hard not to find much not to like about the current market environment, despite some global tensions. Give me your take on what's fueling this confidence, especially given the pullback that we had after the records last week.
Diane, good to see you as well. Always pleasure to be on the show. You nailed it at the beginning of the show. This tug of war between the Bears and the Bulls, it is slightly optimistic when you think about all of the negatives that you could be focusing on right now. It seems as if things are pretty much, if I were a town crier, I would be saying all is well. You've got record highs in the market, as you mentioned. The bond market doesn't seem to initiate any kind of run to safety for investors. It's staying exactly where it would be, even in a good time. Imagine that we weren't having record deficits potentially forecasted in the U.S. economy or global war. This is the type of thing that would typically see bond markets start to be where people are running to, and it doesn't appear to be the case, which is a powerful thing. You also have a Fed that is potentially going to be cutting rates this year. We forecast 2 of those, which will be a tailwind in the market. And theoretically, I believe that this is all due to the optimism of what could be in this American first or America first agenda that we see being passed by the Trump administration.
Given your view that you see 2 happening this year, how do you see that shaping, say, market action through the balance of this year?
Yeah, I believe that the S&P 500 finishes somewhere around a 6,500 point range is kind of what our forecast would be. We have been bullish even in the lows of April simply because of the pent up demand and optimism. Nearly $7 trillion still sitting on the sidelines that hasn't got involved in this. And those who are involved, the money that is working right now in the market is not flooding to safety or leaving the market, going back to cash. That $7 trillion, when it gets added to the market, we do see that being, again, a tailwind in the overall S&P 500 performance. I could see 3% in the next 3 months, maybe 6% additional increase in the S&P 500 over the next 6 months. And again, being very bullish going to the end of the year.
Okay, so I'm curious. I want to know your thoughts on any broadening beyond the Mag 7. To be fair, there's been some bifurcation in the performance within the Mag 7, and we'll dive deeper into a few of the names that are on your list there. But you say, you've pointed out this adage that I've heard before: as tech goes, so goes the market. What are you paying attention to in terms of any broadening beyond tech?
One of the things that we haven't mentioned just yet that is very optimistic about the market is the broadening of the S&P 500. The overall market is not just technology now. It used, like you said, used to be the Mag 7 that took everything higher and led us into the lows of April. But since then, we have seen a significant rally, one that rivals historic rallies of the past, back in the 80s and coming out of 2000's crash and even out of 2020. We've seen these 3-month 25% move from the lows to where we are today in the last 3 months is significant, and it's not all been tech. We've got industrials, we've got financials that are helping lead us out of this. And to be real frank with you, that broadening in the market gives me a lot of optimism for investors in general. We aren't really chasing returns in the tech industry, at least with our clients. We like a little bit of tech here and there, and we've got a few tech names on our list. But the reality is this broadening of the market is a very good thing for every buyer. What I would love to see, Diane, is consumer discretionary potentially climbing a little bit higher. And if we can see that, I think it solidifies this rally that we have experienced thus far in the year.
Dale, let's talk a little bit about some of the names on your list. 2 of those, Amazon and Apple, they've been underperformers compared to the Mag 7. Amazon essentially, flat for the year, just slightly above water. Prime Day's here. That's not necessarily the needle mover when it comes to Amazon. Obviously, you have AWS, etc. Do you think the market is underestimating Amazon, as a performer this year?
In short, yes. The answer is yes. I do think that we've underestimated Amazon because it is not just a high-flying tech company. It's a diversified tech company. When you think about the cloud system that it is putting a ton of money in, last year, you mentioned AWS, last year nearly $107 billion worth of revenue with a significant margin in comparison to its retail side. And we've got advertising that is growing in the Amazon business model. This is a bullish sentiment for us. Amazon is a big buy here. The Mag 7, like you said, there has been that separation of the have and the have-nots of the Mag 7. This is one that stayed pretty flat through it all. I believe that over the next 6 months, Amazon is a buy for the reasons we just listed.
And then let's talk a little bit about Apple. Apple's also been an underperformer more so than Amazon. It's not the weakest in the list, but it's close to the bottom of the list. So what signals are you watching for a change in how it's viewed in terms of its performance with regard to a turnaround for Apple, especially when you still have these tariff concerns?
Well, and namely, that is the biggest concern for us, and that's Apple's impact with Chinese trade war. The tensions that come from the China trade war alone, in our opinion, has been what's held Apple back from the Mag 7. Now, we're not a big proponent of Tesla, but just about anything else, you could throw a dart at the Mag 7, and I think you're going to make money over the next 6 months. Apple is likely the one that has the most upside potential, because when we see China's trade war, when all of that clears out, and the last time we were together, Diane, we were talking about this trade war and how when China clears, things start to look a little bit better. Apple will be the primary benefactor for that, specifically when we're looking at the Mag 7. Apple is a buy for us, and it's simply because of the momentum that will come from an Apple clarity around China.
Okay, and let's talk a little bit about a pick on your list that's outside of the Mag 7, outside of tech. That's J&J, Johnson & Johnson. I believe it's outperformed the S&P 500 so far this year. Do you see a continuation of that trend, and why do you like it?
I do. If you look at the 5-year chart of J&J, you've got this kind of restraint and support bounce back and forth that has weathered many different cycles in the market. J&J has a tremendous amount of subsidiaries, 275 subsidiaries, if I'm not mistaken, that are performing on 26 different platforms, over $1 billion revenue last year. It is incredible when you look at the financials of J&J. It's got one of the largest R&D budgets for pharmaceuticals. And all in all, it pays a significant dividend. So for clients that we're working with that need that stability, maybe need a little bit of dependency, this would be one of those names that continues to pay a strong dividend. We're going to see some capital appreciation over time. It's a household name. And again, long term, I think this is a buy and hold type of strategy. Not a trade here, but a buy and hold strategy to harvest the dividend and benefit from, again, this America First agenda that is to come.
Okay, a bet on the America First agenda there with a Johnson & Johnson, longer-term view there. Dale, thank you so much.
Always a pleasure.
Dale, same. The feeling's mutual. That's Dale Smothers, President and CEO, RDS Wealth Management. Got a lot more to come on